Good morning, stock fans. This is Mike Lee from the Momentum Chat Room.
And I'm John Darsie, Editor-in-Chief of T3 Live. We're bringing you an all-male morning call today, but I wore pink to sort of offset that a little bit. But let's dive right into the action. The S&P had its biggest weekly gain since 2011 last week to close at its highest level since 2007. So if the first week is any indication, 2013 is going to be a great year for stocks. But in the interim, we might need a little bit of rest after a very strong start following the fiscal cliff deal. Mike, what does the chart of the SPY tell you?
Okay, the spiders. We have had a nice rally. I think it was almost 4% gain last week from the fiscal cliff to the first couple days of the year trading. You know, 5-year highs, CNBC's all over it. What sector is the strongest? The banks, how ironic or coincidental, whatever you want to use. You know, 5 years ago, you would have never thought that the S&Ps would be back to almost 1,500, and we're getting close. So my advice to everyone is let the market settle in a little bit here. We had a big run. It doesn't mean it's a short. It just means the S&Ps, the spiders could rest a little, come back in 15, 10 handles, digest, and set up a bull flag to head higher.
Yeah, definitely, especially we're heading into earnings season now. Alcoa is the unofficial kickoff of earnings season. They report earnings tomorrow. Mike, you could take a look briefly at the chart of Alcoa. Last earnings season, we had a tough go of it a little bit. Expectations were low, and we even underperformed those low expectations. And earnings season could be very important to hold us up at higher levels this time around.
Yeah, Alcoa had a really nice move last week. It's one of these, you know, dogs of the Dow every year. It's been beaten up, but right now, okay, Alcoa, if you could just get over, you know, 925 and hold, and you see a lot of resistance around 940. Alcoa isn't a big mover, but it could give us a little indication of what's going on. If this stock ever gets above $9.50, $10 and consolidates, it might be a long-term swing. Right now, I want to see it set up. It was 3 good days to start the year. It needs time to, you know, settle in.
And you touched briefly on the banks, Mike. Basically, we've seen Apple, which is the perennial market leader, really underperform and act very heavy over the last few months, ever since topping out above $700. And during the last 3 sessions, even though it gapped up nicely last Wednesday, it's been weak during the ensuing sessions. And, you know, it closed that gap, which is very bearish, and the macro chart is setting up very bearish. But despite that, the market is holding up very well. And you're seeing that largely because the banks are performing so well. Do you think that's something that will continue, or do you think maybe Apple can strengthen to?
I would have to say there's a better bet that the banks hold in stronger than Apple turn its tune. So here's my thing on Goldman Sachs. Look at this nice consolidation. This thing is breaking out 3-4 month highs. I mean, this is a strong stock and a strong sector right now. Here's the sector ETF, the FAS. I mean, we are at 52-week highs, and we are looking strong. Bank of America, one of the best performing Dow stocks last year, up almost 100%. Here's another nice move. Citi, Wells Fargo. Look at Wells Fargo breaking out right above here. This could be a really nice trade. 35 area with a hold. I think Wells Fargo has room to go. I love the banks right now, but I do think they will come in a little and digest. It doesn't mean they're a short. Everyone says, oh, the banks are extended, I'm going to look to short. No. My advice to you is instead of shorting strong stocks, be patient, wait for the strong stocks to come back in, and look to buy them on a pullback.
Yeah, the important point there is that we don't try to pick tops or bottoms. You know, there's some calculated setups that we talk about, like the red dog reversal, things like that, but we never look to short a group like the banks that are very extended just because they are extended. You wait for a calculated setup. They are a little bit extended off their short-term moving averages, which often act as magnets. But, you know, I think like Mike said, you have to be very patient here. Just because the market is tough to buy at this level doesn't mean you blindly short it. So I think you really have to be careful. Among the banks, you're seeing Goldman Sachs and Citi sort of assert themselves now, where Bank of America had a 20% run since that buy price at $10 that we listed on off the charts in the price point sheet. So I think maybe you rotate into some other names in the banks. Like you said, Wells Fargo looks pretty good. But in general, the banks are a little bit extended. Maybe you don't initiate new positions here and you let them to settle out a little bit. You wait for them to settle out a little bit.
And real quick, with back to Apple, you know, here's Apple's high. Okay, here's a lower high, and a lower high, and then you have your base around 500. So to me, Apple, okay, maybe it's gapped up $1 or $2 down, I think, this morning when I came in, so it's at 525. You're looking at a base at 500, but the highs are coming down, so it's getting tighter. I wouldn't be surprised if Apple doesn't break 500 maybe before the earnings or after earnings and gives you that trade to 450. Then maybe you start getting some new money coming in.
Yeah, you really get the feeling that earnings are going to be huge for Apple this quarter. You have the iPhone 5 come out, and you have the well-publicized issues with supply and all that type of stuff. And then you see, you know, the Samsung phones and all the other Android phones sort of starting to take a little bit of market share. You know, anecdotally, I've seen a few of the Samsung phones, and I'm really impressed by them. I have an iPhone, but I could definitely see the appeal, the larger screen, and some of the functionality of the Samsung phones. And I think that's something that you're continuing to see grow, and you got to be wary of that. Apple's such a huge market cap. I mean, you look at the growth rate of Apple and the price of the stock, the PEG ratio, for example, is very low. So you might say traditionally that Apple still has room to go, but with a stock as, you know, the value as large as Apple, you really have to be careful about, you know, getting involved in a crowded trade like that. Let's go ahead and stick to high beta tech. You see Apple weakening, but you have Amazon and Google that are sort of picking up the mantle as market leaders in the high beta tech sector.
Yeah, I love Amazon. I mean, Amazon's gapping up almost to 52-week highs this pre-market. You know, Amazon to me is a leader. Yes, their earnings weren't that great last quarter. You know, they are, you know, maybe lagging in that department a little bit, but this is a very, very strong company. I mean, we're at 52-week highs as Apple is almost at 52-week lows. So that's a big difference in my opinion. And Amazon is your leader. It almost is the leader in retail. You know, I've been reading a lot of stuff where this is going to take over Walmart 10 to 15 years from now as the biggest retail company in America.
Yeah, I mean, you see retail shifting obviously from the brick and mortar type stores to online, and Amazon is obviously the leader in that sector. The company still struggles to make money, but the future is so bright that analysts and investors typically overlook that. They have a highly respected CEO, one of the most respected CEOs in all of tech, and you know, the price action confirms that Amazon has a very bright future, and I wouldn't be surprised to see it make 52-week highs here soon. It's been sort of a slow grinding type trade as opposed to the Amazon of old that was very whippy and had big swings, but you like to see this type of price action, especially if you're a swing trader looking to play breakouts and stuff like that. You want to see a stock sort of grinds higher, bases at highs, and then takes off after that, and you're sort of seeing a little bit of that with Amazon right now. Now let's move on to Google, which is also sort of reasserting itself after that tough leaked earnings report last quarter that sent it down big intraday. You can see that big wide range bar as we go to the charts, but it's really starting to repair and get back to near its highs.
Yeah, here's your big intraday down move. I mean, it took out a lot of time here, and now it's fighting its way back. This has been since mid-October. We're getting into mid-January. You know, Google looks great. I do think if it stays above 700 long term, it looks amazing. The difference between Amazon and Google compared to Apple on a short-term traders aspect is that Apple does so much more volume. So traders are a lot more comfortable trading in Apple. And Amazon and Google are very difficult trades for a lot of people. They are thin, you know, they are expensive, they are, you know, very hard to control your P&L. As much as Apple is expensive, it's more thick, it's more tradable for traders, and that's the biggest difference. But on a fundamental, on a technical chart, Amazon and Google look a lot better than Apple.
Yeah, I think it's a lesson to momentum traders, people that are in your room, people that want to adopt that momentum style of trading. You don't typically look at stocks like Google to trade from a momentum standpoint as often as you look at other names that are slightly more liquid and lower priced, and the spread isn't as great.
That's exactly right, because it becomes more difficult. The thinner a stock is, the less confidence or control I have, and that's something that I don't force myself into.
Great. And if we're talking about tech, I think right now we have to talk about Facebook.
Okay.
Facebook has really shrugged off those IPO lockup expirations very well. Everyone thought that perhaps the first one would be, you know, a big weight on Facebook, as 30% of its float got the lockup expired on that and flooded the market with more supply on Facebook. But it appears that the insiders that saw their shares, the lockup expire on their shares, they're not eager to sell, and that's a very encouraging thing. and you've seen Facebook really strengthen. And on Friday, we got a nice move out of a sort of mini descending channel. What do you think Facebook can do in the short term and in 2013?
Yeah, I look at Facebook. I like to pull up the weekly on Facebook. Here's the weekly, okay? Here's your big down move. Obviously, the IPO was way overpriced, and it came in and bear flagged, and now it's trying to find support around 1850 and 20 down here. Awesome move. This is great constructive action.
It's like a little bit of a cup and handle if you look at it on a pure technical basis.
Exactly, and then you have your little bull flag here and potential going higher. I do think if you go back to the daily here and zoom in a little bit, I want to see Facebook hold 28 to 30. Okay, I want to see it flag, let it consolidate. If it's between 28 and 30 for another few days, few weeks, that next earning report can spike that thing up to $30, $32. I think Facebook still needs a little time. I do love Facebook longer term. They have too many, people involved in this company, too many, potentials with cell phones and, wireless devices for this company to start making a lot of money. But right now, on a technical basis, it does need a little time. I think 28 to 30 with some digestion, a trade 232 with a little time.
Great. What we've also seen over the past few weeks is some strengthening by some laggard names that a lot of people had written off, names like Groupon, Zynga, Netflix, Green Mountain, that have really perked up in the absence of leadership from a stock like Apple. And there's a lot of theories about why this could be occurring. It could be a January effect type of situation where investors sold those laggard stocks at the end of last year to offset gains for tax purposes, and then now, after the 30-day wash rule, they're buying them back. Do you think the strength can continue in these names, or do you think this is a very transitory type bounce and these are destined for lower prices in the end?
Let's go over a few. Let's start with SODA. SODA is one of those stocks that was in the $60, $70 range, a year and a half, 2 years ago. It's breaking out, looks good. I would rest on this one. I'm not chasing a name like SODA. It doesn't mean it has to come in, but as a short, but it could consolidate back to the 44, 45 area. Don't chase this one. Look at NFLX. I'm just going to go over a few right now. Netflix is amazingly strong. This Disney deal, and then, I think it was Icon. Correct me if I'm wrong there. And then you have a nice base, 88 to 90 support. Resistance 98 to 100. You might see this thing get above 100 on earnings. You're looking at a 10% move. Now, you mentioned Zynga. I personally don't like to trade stocks or even invest in stocks under the $5 mark. That's just the way I have, built my business and built my personal trading. But here is Zynga. It is an extremely spec play. Yes, the moving averages are trying to go up. You had your big bar. You have resistance at 275. Groupon's a little better. You're getting above that $5 mark. Here's major resistance. So 550 in Groupon above that looks pretty good. Here's one, YELP. Here's YELP on the daily. You had a big down move, consolidation. YELP is finally getting above a little bit. Looks okay. So these are spec plays, but I do like to tend to trade a little more expensive stocks. Let's look at GMCR real quick, and then I'll go maybe over one or two solars. Here's GMCR. GMCR is really looking good on the chart. It's another one that we have run. When you run 4% in a week, that's a lot. That's a good gain for some years. So to me, be patient. Be a little more flexible in your trading up here. Don't think it's going to higher. Maybe be speculative short, but buy on pullbacks is the way I would go.
Great advice. You mentioned the solars, and last week the big catalyst for the solars was Warren Buffett-owned Mid-American Solar bought two big solar projects from SunPower, SPWR, in California that are going to create one of the biggest solar power projects in the United States. And that was obviously a big boon for the solar sector when you have Warren Buffett, basically buying in and believing in your story. When a lot of people were writing off solar as an inefficient power source. But you see SPWR was up almost 50% that day. And then you had some sympathy plays like FSLR that really performed well, not as well obviously as SPWR, but let's take a look at the charts of those and see if we think those can continue or whether they're going to fall back down after the enthusiasm over that deal.
So I'm going to pull up the weekly chart on some of these solars because it's been down a lot. Here's SPWR, okay? Here's the Buffett news, $10. Looks pretty clear to me. If this thing could close above 10, maybe this sector or this stock, more specific, can wake up a little more. The way I'm going to play SPWR just for a trade idea, I would like to see it come in $8.50, $8.25, $8, maybe buy some calls on it, maybe buy the 10s mid-January, mid-February going into an earning play, or potential just buying some as it comes in, and maybe this thing will set up again a couple weeks from now. Here's the other two strong solars that I would stick with is TSL, potentially, if it could close above $5, I do think this one has the potential to get back to 10. And FSLR had its run early, back in November, December. If I go back to the daily and FSLR, it's had a nice run. Here's your wedge. It got tight. It broke above 26. A couple bull flags in between. So this stock has run from 26 to 36. It just needs time. I think a couple firms came out speculative, even selling their FSLR into strength. So just give it a little time.
Yeah, I think one of the lessons here with all these laggard stocks, whether it be the ones we talked about previously or the solars, is that whenever consensus is reached and it seems like everyone believes the same thing about a group or a stock, that's when you really got to be careful in that direction. Everyone had written off the solars, everyone had written off Groupon. Groupon has almost doubled since it bottomed out below $3. The solars obviously have made a great run. Just be careful of consensus and be careful of the herd mentality. And if you can sort of separate yourself from that and take a little bit of a contrarian view every once in a while, you can really find some great opportunities. The banks are a good example of that as well. Everyone's focused on high beta tech and Apple and this and that when the banks are sitting here going up 20, 30% over the course of a few months. So,
I totally
don't
agree
always listen to the headlines. Don't always listen to what they're talking about on CNBC. They talk about the banks on CNBC also, but just sort of separate yourself from that herd mentality a little bit. I think one more thing I would like to cover is gold and silver. You saw last week the Fed minutes came out, and basically several of the Fed governors that vote on the FOMC are of the opinion that QE could end in 2013 at some point. And that sort of really spooked investors a little bit. The market held up reasonably well. Obviously, we closed at the highest levels we've seen since 2007. But I think the reaction you saw in gold and silver, a little bit of a preview of what you could see in the market and in the metals if the Fed follows through with that. But that statement did come with the qualifier that they'll only end QE if employment starts to tick up and reach comfortable levels.
Stays strong, and
so it's a very they qualify that statement a lot. But still, that idea spooked investors in the precious metals a little bit. And after a good run in the second half of 2012, what do you think we could see from the metals? They're looking a little bit precarious in this spot.
Yeah, the thing is, do you buy gold on weakness and put it away? Longer term, I think it's a great play. I do think by the end of this decade, we'll see 2,000 on gold. But that's long term, and some people don't have the money to sit, and they got to make it to work. So to me, I see GLD. You have your support at 158 right here on the charts. If you look at 158 as a base, you could sort of play into that. It's closed around 160. I think silver is a lot, to me, potentially weaker. It's going to look like if it breaks, 28.50, this thing's going back to 27. It's cheap. Silver had its run back in August, September. That's it. Look at this move, 27 to 34. You might not see $34 for a while. I tend to stay away from them. But if you look at some metal stocks, real quick, X, okay? I'm going to show you the weekly on X. I was looking at this morning, and I do see potential here. I think X, okay, could be a good stock this year. I think if housing stays strong and our economy gets better, U.S. Steel is one of those stocks that I would look to try to buy on pullbacks. Maybe, buy some calls a few months out. But this thing gets above 30, we could see $40, $45 in X this year. I like this play. Yeah,
you could also look at copper as a play on, an accelerating economic recovery a little bit. I can't remember the symbol, but the JJC is a way to track copper. They also came out with a copper ETF last week, one of the first of its kind. But you're seeing copper really tick up as people get a little bit more optimistic about the economy the recovery accelerating a little bit. You know, we've seen the economy continue to recover slowly under President Obama, and you know, unemployment's ticking down a little bit, and housing has improved, but we're sort of reaching that point where it's either, you know, put up or shut up. We really have to start improving at a faster rate, or we could risk going back into recession. But
and let me just pull. I'm sorry about that, John. Let me just pull some stocks here. When you see Ford, okay? Oh, Ford, whatever. Here's the weekly chart. This thing was unbelievable move right now. I mean, we were at 10 back in October, November, and we're at 13.50. Closing above $13 on a weekly, monthly basis. This looks amazing, Ford. Look at GM, you know, another stock that's fighting its way back. I mean, these are stocks that, look at John Deere, DE above 90 looks really good. Held in there all this, anytime the market pulled in, John Deere held in, pays a nice dividend. There are ways to make money. You don't have to concentrate on Apple. As a trader, it almost frustrates me listening to TV and the trading floor, Apple this, Apple that. Is it going to break 500? We don't know. Who cares? But what we do know is John Deere holding in. And
if you look at Toyota Motors, that's was one of Scott's plays in his 2013 predictions. And if you zoom out to the weekly, it has a good-looking pattern. And you've seen, obviously, the recent price action has been very well.
Here's the monthly on it, and we are, you know, breaking out. Get above $100, and the Nikkei has been extremely strong. I mean, it went up 1,000 points. You fell asleep for a week, and there it goes. So these stocks are looking good. There's a lot of sectors out there. I think, to me as a trader, I'm going to use this first earnings season as a really big indication on what's going to be strong for 2013 and what potentially could be weak. And I'm going to filter out, and I'm going to take the 20 strongest stocks on earnings and the 20 weakest, and that'll be my year. And you got to set yourself up for a nice 2013. And I think earnings this year in January is going to be a good start.
I think that's great advice. And you know, like we talked about, avoid the herd mentality. And when consensus starts getting too heavy in one direction, be careful a little bit. And I think we're seeing a little bit of that after a great start to 2013, 4%. I mean, for a year, that's a great gain, a great year. We have the debt ceiling situation coming up. We have stocks extended off their short-term moving averages. We have earnings season coming up. So there's a lot of things that really could slow us down or they could accelerate us. But I think right now the prudent approach is to sort of trim and trail, as Scott says, lower your expectations slightly in the short term, but just start to look at patterns that are constructive, and that if we get some consolidation, look at what stocks you might want to focus on. But you know, I don't think this is a spot to really be initiating aggressively new positions.
I totally agree. And you know, just a little advice. To me, the market is something that we really don't have any control over, but what you do have control over are the positions you enter, the profits you take, and the losses that you could control. And those are the three things that I would focus on this year. Sell into strength, don't chase, buy strong ones into weakness, short weak ones into strength, and you'll have a good year if you stick with your rules and trust yourself.
Great words of advice, Mike, and that's the morning call. On behalf of Mike, Lee, and John Darsie, thank you for joining us. We'll see you in the virtual trading floor and on the site this week. Thank you.
Hi, I'm Sean Hendelman of T3 Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3 Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.